Hello and welcome back to Market Shares. I'm your host, Tony Blodgett, and today I'm going to talk about two executive orders that we got here just last week on March 13th coming out of the Trump administration, both having to do with housing. So we're going to jump into this in just a second. There's so much going on around the mortgage industry. I could probably do a 3-hour podcast, but I'm not going to do that to you. We're going to focus on these two things. And then next week, we'll have a more in-depth market update on what's going on with oil prices, interest rates. We have a Fed meeting that happened this week. It's happening the day after I record this episode, so I have no update for you on the Fed meeting, but I can pretty much guarantee the Fed is not going to move overnight rates at all in this meeting. I'm very interested to hear what they have to say about the continued softening in the labor market. We've seen just really bad jobs numbers. Obviously, a pretty significant fear of inflation creeping back in with the jump in oil prices, pushing mortgage rates that were flirting at, the high fives right back up into the mid sixes pretty quickly. So we'll talk more next week if that's going to settle back down for all of us. But let's talk about these two executive orders that were both signed on March 13th, both aimed at the housing market, but each of them taking a little bit different approach. One is focused on creating more inventory in the market, right? More supply of houses. And I'm going to talk about how it's going to attempt to do that. And the other one focused on more availability of credit, which is interesting. This one, as a mortgage lender, I have a little more thoughts about, I think. And it's pretty broad, the way that these executive orders work. Now, keep in mind, this is not an executive order that's going to actually change any policy like today. And matter of fact, a lot of what is in these is suggestions on what should be looked at and evaluated. So we don't know exactly what the impact is, but let's talk about these two regulatory changes and what they could potentially mean for those of us in mortgage and real estate. The first one is around removing regulatory barriers to housing construction. Now, we have talked about this in the past. You've heard the president talk about this on a number of occasions, and this executive order is directing federal housing agencies to identify and eliminate regulations that increase housing development costs, targets permitting delays, environmental review requirements, and certain energy mandates, encourages state and local governments to reconsider zoning and density restrictions tied to federal funding. Now, let's talk about that one just for a second. I'm in Washington State. We've seen significant sweeping changes to the local zoning and availability of detached ADUs and attached ADUs and what we call middle housing, where you could take down a small existing home, build up to 6 units on a standard building lot. So we've definitely seen, at least in my local market, some pretty significant changes. And this was a state law that mandated that these local municipalities make these changes. So it looks like the president's just pushing this further. Maybe other states have not gone as far as Washington has so far in this regard. And maybe we continue to see a movement in that direction. So I thought that was interesting. The other one is that I just mentioned, that the delays, the environmental review requirements, things of that nature. Keep in mind, some of this stuff there would need to be changes made at a state and local level. And depending on what state you live in, there may be more likelihood to adopt a loosening of some of these policies, specifically around environmental reviews and things of that nature, right? So Just know certain states are going to be much more focused on that. Probably the same states that have, policies already around, green energy and, carbon taxes, things of that nature. Obviously, the local legislature has a focus on that. So they'd be less likely to ease up as much as you might see in other parts of the country. But that's what's being encouraged. Promote innovation in construction methods to accelerate housing development, right? So we're talking about, and I think I mentioned this just a couple episodes ago. This could be, the building of homes off-site in factories. We're seeing a lot of growth in that area. This could mean, the allowing of different types of construction through automated ways. You've seen like these 3D printers that like print houses, right, out of, concrete or whatever. Maybe we see, some regulations or loosening of regulations around different kind of out-of-the-box building methods that we haven't seen in the past. And then review federal building codes and water or energy requirements that add to construction costs. So just a lot of loosening of regulatory requirements around new construction and housing. You guys, this is nothing new for the Trump administration. They really led on this, just the whole idea of removing regulation. And that's what this is. This just happens to be geared specifically towards housing with the thought of increasing some more inventory. So in theory, this could mean permits get approved faster. It could lower the cost for builders, which could bring down the cost of new homes. It could expand housing inventory nationwide. So that's really the goal. The second executive order, which is promoting access to mortgage credit. Now, this one's interesting. Federal regulators were directed to review mortgage rules that may restrict lending. Look, if you're keeping up with what's going on in the mortgage banking, mortgage industry as a whole, you're seeing a huge growth in non-QM loans, right? Non-qualified mortgage lending. It's growing massively. And I'm talking about your bank statement loans, 12 and 24 month, P&L loans, asset depletion loans, DSCR. And what's interesting is now the president is asking, bullet point number 2, CFPB is asked to revisit the qualified mortgage rules and safe harbor definitions. So this all harkens back to Dodd-Frank, right? When the qualified mortgage became a thing. The reason we have non-QM loans is because we have QM loans, right? So the fact that Fannie and Freddie will not purchase any loans that are not qualified mortgages, now the president is asking the CFPB to revisit this and revisit the rules of what is a qualified mortgage. What does this mean for us? Well, it could mean that some of this growth of product that we've seen happening in the non-QM space might become more in line with conventional financing, right? It may be maybe Fannie and Freddie at some point are, looking at purchasing some of these loans. We don't know that. It doesn't say that specifically, but that's the direction you could see things go as we've seen non-QM grow. Maybe what is now non-QM becomes no longer outside of the QM rules if they expand those, which I wouldn't be surprised one bit if they did. There's other things that QM requires, right? Like debt to income ratio requirements, things of that nature. All of those things could mean an expansion of credit availability, both through FHFA, Fannie Freddie, as well as potentially, FHA, VA, etc. They also outlined the potential simplification of TRID disclosures. So I think if you're in this industry as long as me, you remember the TRID and the ridiculousness around TRID when it rolled out. I think we've all become accustomed to it, but there is, some limitations with TRID. And so maybe there is some loosening of those guidelines a little bit. That's going to be revisited by the CFPB. Review of capital and liquidity requirements that affect mortgage lending. So I think this will have to do with, this could impact warehouse lending, how warehouse lending is classified within the banks that offer warehouse lending, right? And kind of loosening the capital requirements there. That could provide more liquidity to mortgage companies that use warehouse lines to fund their loans, giving more people access to larger warehouse lines, potentially at lower costs, etc. It also could mean that smaller entities that are restricted by capital requirements could, be more willing to grow in size and be able to accommodate that with some, loosening around liquidity requirements for both banks and non-banks as well. Consider expanded mortgage-backed security purchases by Fannie and Freddie. We talked about this when Trump came out and said that he was going to have FHFA purchase $200 billion of mortgage-backed securities. This is now in this executive order for Fannie and Freddie to expand and grow their holdings of mortgage-backed securities. And then lastly, evaluate broader access to federal home loan bank advantages for lenders. This is mainly focused towards small regional banks that access the Federal Home Loan Bank versus their loans going directly to Fannie or Freddie. And look, overall, part of the intent here is to bring local lenders, and by local lenders, I mean local banks, back into mortgage lending. We saw such a tight regulatory environment that not only did you see the big national banks really pull back from mortgage lending, and you can't really blame them with the amount of money that was, levied upon these companies through the DOJ and just all these lawsuits and from HUD and, just everything. Wells Fargo and banks like that paid so much money in fines. They just finally said, look, we're just not even going to be involved in government lending at all, or very, very little. And that's what they did. And the benefactor of that was the independent mortgage banking companies, and brokers and the like. Independent mortgage banks, I think, currently have 65 to 80% of mortgage lending, and that was a lot in part to the banks backing out. And so this idea is to bring banks, and specifically local banks, regional banks, back into mortgage lending. So it'll be interesting to see how that plays out. And then, the intended outcome of this: increase availability of mortgage credit. Obviously, that helps bring down costs, potential reduction of mortgage borrowing costs as a result of competition, and more participation from community banks and smaller lenders. Now, I wanted to talk specifically about, what is the impact to independent mortgage banks? Because I work at one, and they do dominate the majority of the space right now. And the possible increase in competition, I think competition is a good thing. We want more competition in the marketplace. That's what, free markets are based on. And that could help bring down interest rates. I think the easing of QM rules and TRID could definitely benefit IMBs, mainly because they're very quick to adopt these new changes. And so there could be a competitive advantage initially because the independent mortgage companies will tend to move quickly. I will tell you that, as much as this is a lot geared towards helping regional and local banks, those are probably the least to act. I mean, they'll be the last to act. They want to see that everything truly is in place before they make any changes. And look, the reality is, if you've ramped down your mortgage operation, it's not just like the flip of a switch to ramp it back up. I mean, there is significant cost required to build out a mortgage infrastructure, not just for the local banks, but for the big banks as well. I mean, they have basically scaled their operations down to next to nothing. It takes not just time, but also the desire and a long-term strategy to grow back up your mortgage operation, where the independent mortgage banks would move pretty quickly on adopting any changes in policy regarding QM and TRID, et cetera, potentially lowering their cost to originate, and picking up more of that market share initially, right? Knowing that there could be challenges down the road with more competition coming back into the market. As I mentioned, possible improvements to warehouse funding costs and access to liquidity that would really help some of the smaller independent mortgage banks. Expanding the credit box, allowing for more flexible loan products. I think we're seeing those products in the non-QM space. It's just, do they become no longer kind of, out of what would be considered a qualified mortgage? And potential growth of the purchase market if housing supply increases. So with these two things working together, if we did see an increase in housing supply and we see loosening in credit, obviously could mean good things for the overall mortgage and real estate as an industry. Potential risks and concerns. Many housing supply challenges are local zoning issues. That's what I talked about. Like, at the end of the day, the president can say what he wants, but if local municipalities and local governments don't adopt these changes, then you wouldn't see much change in those areas. There is a risk, obviously. We all were here, not all of us, but many of us were here to experience what happened in the mortgage meltdown in 2008. There is risk of loosening mortgage guidelines. Now, I think that it's been so restrictive, and we do have the qualified mortgage definitions. I think reviewing those to expand them doesn't sound super risky to me, but you never know where that could go. Could it end up with a full repeal of QM altogether? And then we're kind of back to, the crazy days that we saw. I don't suspect that's going to happen. There's so many other safeguards in place that I personally believe would keep that from happening, but it's a risk. You don't know where that could go. And I still think banks are going to be really slow to re-enter the mortgage market, even with these changes. But you guys, I did want to talk about this just really quickly, because whenever you see something from the federal government, from the Trump administration, an executive order, and it's specifically looking at housing, I got to commend them just for trying to do what's possible to make home ownership more affordable. I think that's the intent behind these actions. Now, how they play out, only time is going to tell. But I do think it's interesting, the revision, or the idea to look deeper at what is a qualified mortgage, what are those rules, are they outdated, should we change those, and potential changes to TRID. That's, to me, the most interesting part of this, and how that ends up playing out. And I think it'll just be time will tell exactly how that's going to play out. So you guys, next week, I am going to talk a little bit more about what's going on with interest rates and what I think is going to happen. I'm going to listen to what Jerome Powell says here this week and have a chance to digest that. So next week, we're going to talk about that. We're going to talk about oil prices, where they're at. I will say this, is that the first couple days of this week, you're going to be watching this on Fridays when it comes out. The first couple days of this week have been good for interest rates. It looks like we've stabilized and we've started going up. It looks like the candlestick chart is forming a Morningstar pattern, which, after a big drop like this, that is a good sign. And we have a lot of room for improvement, back up to our next level of resistance. So, hopefully the Fed is good with his comments and doesn't say anything that really spooks the market. We don't really need that right now. We need a very dovish tone from Jerome Powell in his presentation, and hopefully we can recover some of this, because the most frustrating thing for me is that everything was really sizing up for an incredible spring. We had already seen purchase applications increasing. Interest rates were flirting with that 6%, dipping under 6% on many loan products for many borrowers, depending on credit score and down payment and, points and all the things. But bottom line was, rates were looking really good. And it's spring. It's just that time of year where the market typically picks up. And then all of a sudden, we see this big spike in interest rates, kind of throwing a wet blanket on our party here. And I'm hopeful that we see a quick recovery, and it'll be interesting to see what Jerome Powell has to say about that. So next week. Tune back in every Friday, you guys, at 10 a.m. We drop a new episode of Market Shares. So subscribe to the channel so you don't miss our next episode, and I will see you then. Take care.